All right, get ready, because today we're going deep on this paper that might totally change how you think about corporate finance.
Oh, yeah.
Yeah, it's a 1984 paper, a bit older but super relevant, called Corporate Financing and Investment Decisions When Firms Have Information That Investors Do Not Have.
I see.
Quite a mouthful, I know, but stick with us. It's a fascinating one.
It really is. It's a classic in corporate finance.
It is, and it kind of cracks the code on why companies sometimes do things that seem, well, a little crazy.
Right, like turning down a project that's guaranteed to make money.
Exactly. So the core issue here, the culprit, if you will, is information asymmetry.
Which basically means that the folks inside the company, the managers, they know a lot more than the rest of us about how much the company is actually worth.
They do. They have that insider knowledge.
It makes sense when you think about it. Managers are dealing with the company's operations day in and day out.
They're in the trenches.
Exactly. They see the potential of new products. They understand the competitive landscape. They have a much deeper understanding of the company's strengths and weaknesses, all stuff that most investors don't have easy access to.
Right. So let's paint a picture here. Imagine a company that has this amazing investment opportunity.
Sounds promising.
It is, but they need some cash to actually get it off the ground.
So what do? Issue new stock.
That's usually the go-to move, right? Raise some capital and get the project rolling.
Makes sense.
But here's the catch. What if the market has actually undervalued the company's stock?
So the stock is trading for less than it's really worth.
Exactly. And if they issue new shares at that lower price, it's like they're selling themselves short.
Diluting the value for the existing shareholders.
Exactly. And the management, if they're acting in the best interest of those shareholders, might decide to just walk away from the project.
Wait, really? Walk away from a profitable opportunity?
I know. It's hard to wrap your head around it.
It seems counterintuitive.
It does. But remember, we're working with this assumption that the management has a much clearer picture of the company's true value than the market does.
So they're stuck between a rock and a hard place.
Right. Either they damage the existing shareholders by selling stock too cheaply,
or they miss out on a potentially lucrative project.
And that's where Myers and Majluf come in. They actually prove this concept with a really clever scenario.
Oh, I'm intrigued. Tell me more.
So they set up this scenario in section 2.2 of the paper.
Okay.
It involves a company that's facing two possible states of nature. It's like a coin flip.
Heads or tails?
Exactly. Heads, the company's existing assets are super valuable. Tails, they're worth less. And only the managers know the outcome of the coin flip beforehand.
Ah, I see where this is going. So how does this coin toss scenario tie into the whole stock issuance dilemma?
So let's say the company has to issue new stock to get the funding for this new project.
Okay.
Now, when the market sees the company issuing stock, what are they going to think? They don't know if the coin toss landed on heads or tails.
Right, so they're going to have to make some assumptions.
And most likely, they're going to assume the worst.
That the company needs the cash because its existing assets aren't doing so hot.
Bingo. That perception then drives down the price that investors are willing to pay for the new stock.
And that's the problem.
It is, because if the coin toss actually landed on heads, meaning the company's existing assets are actually doing great,
then issuing stock at that lower price would be a terrible deal for the current shareholders.
So even though the company knows the project is solid, they decide to walk away.
Wow, it's a perfect example of how this information gap can lead to what looks like totally irrational behavior from the outside.
But as we said, the company isn't making a bad decision. They're making the best decision they can with the information they have while trying to protect the existing shareholders.
It's a fascinating dilemma.
It is, and it leads to a bigger question. Is there any way for companies to get around this problem?
That's what I was thinking. It seems like a tough spot to be in.
And Myers and Majluf offer a solution. Financial slack.
Financial slack, what's that?
Think of it as a financial safety net, having enough cash on hand, some marketable securities, or easy access to credit lines.
Okay, I'm following.
So if a company has enough of this slack, they don't have to issue new stock to fund these new projects, which completely sidesteps this whole signaling issue.
Interesting. So that explains why some companies seem to sit on piles of cash even when analysts are telling them to do something with it.
It's like their emergency fund, but at a corporate level.
It gives them options and breathing room. They're not forced to make tough decisions that could hurt their investors.
Exactly. So financial slack is definitely a good thing to have.
For sure.
But what if a company absolutely has to raise money from external sources? What's the best way to go about it then?
That's a great question.
This is where the paper gets even more insightful.
Oh, lay it on me.
Myers and Majluf argue that if a company has to go outside for funding, it's usually better to issue debt, like bonds, than equity, like stock.
Interesting. I would have thought taking on debt would be riskier for the company.
It does add risk, but debt is actually seen as less risky from the investor's point of view.
How so?
Because lenders, the folks who buy those bonds, they get paid no matter what. They have a fixed claim on the company's assets.
Right.
But stockholders, well, they only get a share of the profits if the company does well.
So debt financing kind of minimizes the impact of information asymmetry. It sends a clearer signal to investors.
That's the idea. Companies might prefer debt because it avoids some of those signaling problems that come with issuing stock.
It's a way to raise capital without spooking the market or upsetting current shareholders.
Precisely. This is really fascinating stuff, isn't it?
It is. It really makes you think.
But wait, we've been talking about debt being better, but companies do issue stock sometimes.
Right. So how does the paper explain that?
It's a good point, and while Myers and Majluf suggest that debt is generally the way to go, they do acknowledge there are times when issuing stock makes sense.
Okay.
For example, if investors think a company is riskier than it actually is, issuing stock can actually help correct that perception.
Yeah. It's like saying, hey, we're so confident in our future that we're willing to let new investors get in on the potential upside.
Exactly. Issuing stock in that scenario can boost investor confidence and make the offering more attractive.
So it's not a one-size-fits-all situation.
Not at all. Choosing between debt and equity financing depends on the specific circumstances. It's all about context and strategy.
It's about carefully weighing the information asymmetry, the company's risk profile, and the details of the investment opportunity.
Absolutely. Okay, before we move on, there's one more area where this information asymmetry thing plays a role. Mergers and acquisitions.
Oh, yeah. How does that work?
Remember how we talked about the value of having that financial slack?
Yeah, that safety net.
Well, imagine one company that's sitting on a pile of cash and another company that has amazing investment opportunities but just doesn't have the funds to chase them.
Sounds like a perfect match.
It could be a merger, could be the solution.
One company has the resources, the other has the ideas. It's a win-win.
In theory, yes, but guess what complicates things?
Don't tell me. Information asymmetry.
You got it. The company with all the cash doesn't want to overpay, and the company with the great ideas doesn't want to sell themselves short.
It's a delicate dance.
It is. Both sides are trying to figure out what the other is really worth without showing all their cards.
So how do they navigate that?
Well, the paper suggests that mergers that are started by the company with the cash, the buyer, are more likely to be successful.
I wonder why that is.
Think about it. If the company with the investment opportunities goes to the buyer first, it might raise some red flags.
Like, why are they so eager to sell? Are they desperate? Maybe those opportunities aren't as good as they're making them out to be.
Exactly. But if the buyer approaches the seller, it sends a different signal. It suggests they see real value in the other company and are willing to back it up with their cash.
So the act of initiating the merger itself can actually influence whether the deal goes through.
It's another fascinating example of how signaling and perception play a crucial role in these big financial decisions.
I'm starting to see just how much this information asymmetry idea affects the world of corporate finance.
It's everywhere. It's not just about numbers. It's about psychology and strategy.
You're absolutely right. Understanding information asymmetry is key to understanding how companies make decisions about everything from raising capital to investing to merging with other businesses.
This has been a really eye-opening discussion so far.
We've only just scratched the surface. There's so much more to explore.
There is. In part 2, we'll dive even deeper into Myers and Majluf's groundbreaking work and uncover even more surprising implications of their research.
Can't wait.
Welcome back. I'm still thinking about all the stuff we talked about in part 1.
Yeah, it really gets you thinking about how companies make decisions.
It does. And before we move on, I wanted to circle back to something that really stuck with me.
Oh, yeah. What's that?
We talked about how this information asymmetry thing can actually lead companies to pass up profitable investments.
Right, even when they have plenty of cash on hand.
Yeah, that part, it just seems so counterintuitive.
It does on the surface, but when you really understand how information asymmetry works, it makes sense.
Help me understand then, why would a company, like with a big pile of cash, say no to a project that everyone thinks is going to make money?
Okay, so imagine a company, they're flush with cash, they could fund any project they wanted.
Sounds like a good position to be in.
It is. And then this amazing investment opportunity comes along, maybe a new product, a strategic acquisition, something with real potential.
Okay.
And the management team, they know this project is a winner. They have that insider knowledge.
So they have the cash, they have the opportunity. What's the holdup?
The problem is that the investors out there, they don't have the same level of information.
Right. They see the company making a big move, but they don't know all the reasons behind it.
Exactly. So they start filling in the gaps with their own assumptions.
And those assumptions aren't always good.
Not always. They might think, oh, the company's core business must be struggling if they're investing in something new.
This is just a desperate attempt to stay afloat,
Right. And that kind of negative perception can actually hurt the company's stock price.
even if the investment is a good one long term.
Exactly. So the management team, even though they're confident in their decision, they have to consider this potential hit to their stock price.
It's like they're being punished for making a smart move.
It's a tough spot. Remember, we're assuming these managers are rational. They want to do what's best for the company, but they also know how the market reacts.
So they're caught in the middle.
Trying to balance the long-term benefits of the investment with the short-term damage to their stock.
And sometimes that short-term damage is just too much to ignore.
It outweighs the potential gains.
So even with all that cash, information asymmetry can still create problems.
It's a real challenge.
Is there any way to avoid this?
Well, one way is to build a strong track record, a history of successful investments.
So investors start to trust their judgment.
Exactly. If they see a pattern of good decision-making, they're less likely to panic when the company makes a big move.
It's about building credibility over time,
That's a big part of it. And the other key is transparency.
being open about their decision-making process.
Exactly. Explaining the rationale behind the investment, highlighting the potential benefits, addressing any concerns investors might have.
It's like saying, we know you don't have all the information, so here's why we're doing this.
It's about building trust and minimizing that negative impact of information asymmetry.
When investors feel like they're in the loop, they're less likely to freak out over every little thing.
You can see the bigger picture.
This is making a lot of sense. So we've talked about how information asymmetry affects investment decisions, both when companies need to raise money and when they have cash on hand.
Right.
But there's another area Myers and Majluf talk about that I wanted to touch on. Dividend policy.
Dividend policy, how does that fit in?
Well, remember, investors are always trying to figure out what's happening inside a company.
Especially when they suspect that managers know more than they do.
Exactly. And dividend policy can be a way for companies to signal their confidence to the market.
Okay, I see where you're going with this.
Because a dividend is a cash payment to shareholders, if a company increases their dividend, it's like they're saying, we're doing great, we have so much cash, we're sharing it with you.
It's a sign of strength and stability.
Right. But then on the flip side, a dividend cut, well, that usually doesn't go over so well.
Investors see that and think, trouble. The company must be in trouble.
That's often the initial reaction, but it's not always the right one.
It's all about context.
And remembering that companies are trying to manage those perceptions.
So a dividend cut could actually be a way of saying, we have this amazing investment opportunity. We need to hold on to some cash for now, but trust us, it'll pay off in the long run.
It's like taking a temporary hit to fund something that will benefit shareholders down the road.
Exactly. Investors need to be careful not to overreact to dividend changes without considering the whole picture.
So a dividend increase isn't always a guarantee of future success, and a dividend cut isn't always a sign of doom and gloom.
Right. It's all about interpreting those signals in the context of everything else you know about the company.
Are they investing in growth? Are they facing tough competition? What's their overall financial health?
Those are the important questions.
This is totally changing how I view dividend policy. I used to just focus on the numbers, the payout ratio, the dividend yield.
Right, but it's more than that.
It's a way for companies to communicate with the market, to signal their intentions and their confidence level.
That's a great way to put it. Dividend policy is another piece of the information asymmetry puzzle.
Companies are always trying to manage those investor expectations.
And dividends are one tool they can use to do that.
I think this is a good place to wrap up. Part 2 of our deep dive, we've uncovered so much about how this information asymmetry idea affects corporate decision-making.
It's been fascinating.
It has, and we're not done yet. In Part 3, we'll step back and explore the bigger implications of Myers and Majluf's work.
What it means for investors and business leaders today.
It's going to be great. Make sure to join us for that.
Yeah.
Welcome back to the deep dive. It feels like we've been on this incredible journey with this paper.
It's been a deep dive for sure.
It has, and in parts 1 and 2, we saw how information asymmetry, that imbalance of information, affects so much in the corporate world.
It really does. Stock prices, dividend policies, even those merger negotiations.
We even talked about how it can lead to companies making decisions that seem, well, kind of crazy from the outside.
Right, like turning down a profitable project even when they have the cash.
Yeah, who would have thought that having too much cash could be a problem?
It's definitely a unique problem to have.
But now that we've really broken down how it all works, I'm curious about the bigger picture.
The big takeaway.
Exactly. What does this all mean for investors and business leaders today?
That's the key question, isn't it?
It is, and I think one of the most important things we've learned is that information asymmetry isn't just some theory.
Right, it's not just an academic concept.
It's a real thing. It's happening all the time in the financial markets. It's always there influencing decisions.
It's like an undercurrent.
So investors can't just ignore it. They have to factor it into their analysis.
You have to be aware of it, absolutely.
So no more just reacting to headlines or taking things at face value.
Exactly. Dig a little deeper, do your research, and try to understand the company's motivations.
Like, why are they issuing stock? What are their big investment plans? Does their dividend policy make sense with their overall strategy?
Those are the questions investors should be asking.
It's about seeing the whole picture.
And remembering that those company managers, they often have information that investors don't.
So we have to pay close attention to how they're communicating, both through their actions and what they're actually saying.
It's like a game of strategy.
It is, trying to read between the lines and figure out what's really going on.
Every financing decision, every announcement, every dividend change, they're all clues.
So that's the investor side of things, but what about for the business leaders themselves?
Well, for them, I think the big lesson is to manage those investor expectations.
To be aware of how their actions are being perceived.
And to make sure they're communicating clearly about their strategy and their decision-making process.
Because even a good decision can backfire if it's not explained well.
It can. Transparency is key.
And that brings us back to the importance of having that financial slack.
That cushion, that flexibility.
It gives companies the freedom to make those long-term decisions, even if it creates some bumps in the road.
It's about playing the long game, building a sustainable business.
This has been an incredible discussion. It's really made me rethink how I look at corporate finance.
It's more than just numbers.
It's psychology, it's strategy, it's this constant interplay between information and perception.
You got it. And Myers and Majluf, they really highlighted that even in today's world, with information everywhere, this information asymmetry is still a powerful force.
So to everyone listening out there, whether you're an investor or a business leader, keep these insights in mind.
Be skeptical, do your homework, and think critically about those signals companies are sending.
And remember, there's always more to the story than what you see on the surface.
Absolutely.
That's all for this week's Deep Dive. Thanks for joining us.
It's been a pleasure.